What's up, guys, and welcome back to Wall Street Millennial. Billionaire investor Chamath Palihapityia has taken the spotlight in 2020 and 2021 by sponsoring 6 SPACs, including the one that took Virgin Galactic public. More recently, during the GameStop short squeeze, he was one of the first high-profile investors to come out in support of Wall Street bets and even took part in the action, buying roughly $125,000 worth of GameStop calls. He gained respect among retail investors by defending the legitimacy of the individual investor and saying Wall Street bets users can perform DD on the same level as hedge fund analysts. But despite his recent success, Chamath is not without his own critics. Following the GameStop saga, famous short seller Carson Block of Muddy Waters Research called Chamath SPAC Jesus and claims he only jumped on the GameStop bandwagon as a publicity stunt to gain credibility among retail investors. This way, he can get more retail investors to buy into his future SPACs and pump up the price. Chamath has become an extremely polarizing figure. Some view him as a hero, giving retail investors an opportunity to participate in high-growth tech companies he is bringing public through his SPACs. Others view him as a charlatan who is promoting his SPACs to unsuspecting retail investors for his own financial gain. A few days ago, Chamath went on Bloomberg television for a wide-ranging, hour-long interview where he went over his views on the GameStop saga, his SPACs, and future ambitions. We highly recommend that you watch the full interview on Bloomberg, link in the description below. In this video, we're going to go over the highlights of the interview where he answers some of those criticisms and explains his future plans.
To those who don't understand your anti-establishment appeal, what do you stand for?
I think it's sort of defined in the mission of social capital, which is that I believe in an even starting line. I think that's probably the simplest encapsulation of my belief in how the world should work, which is that, we should all effectively get access to the same resources, and that as many of us as possible should be allowed to get to the starting line, and then the gun should fire, and then the outcomes will be what the outcomes will be. And I think a lot of us feel that that isn't necessarily always the case, that there's kind of entrenched hierarchies that prevent progress. So I push against those because they touch a very deep emotional part of my value system. And I just don't think that the world is a better place for them. And I think we're better off without them.
He starts off talking about how income inequality is bad and how he wants to change it. While we can all agree with that sentiment, it's unclear what this has to do with investing and picking stocks, which is the business he's involved in.
Why were you so excited by the GameStop short squeeze and then so outraged when Robinhood had to throttle buy orders?
Look, on the way in, I think what GameStop showed was the narrative fallacy on Wall Street. I think for years, there was these folks that sort of, were these wizards behind the veil. And they had a way of conducting themselves that purported to be just intellectually superior to everybody else. But in reality, what that short showed was that they were prone to the same, poor decision-making and broken systems and technologies that everybody else has to deal with. And so I found that kind of funny. I think it also spoke to the fact that we really haven't looked closely enough at the systems that were broken as a result of 1998 and LTCM, long-term capital management, then 2006, 7, and 8 with Bear and Lehman. And we're allowing the same problem, slightly different, but roughly the same problem to repeat itself over and over again. And so that's what sort of angered me about GameStop. And then on the back end of it, I just felt like these two worlds collided in a way where I doubt that in the end, in the final analysis, there was any collusion of any kind. But just the stench of this whole thing just goes to show you, back to where we were talking about before, about how difficult it is for normal, everyday folks to have access to any kind of return.
He explains that while hedge funds are supposedly sophisticated money managers, the reality is that they are just as vulnerable to making mistakes and losing money as retail investors. The DD posted on Wall Street Bets is often much higher quality than research published by Wall Street investment firms, who probably would have told you to short Tesla in 2016. He also explains how hedge funds have become too big to fail and are allowed to take on too much leverage. Hedge funds shorted more than 100% of GameStop shares, which created the unstable position that made the stock vulnerable to a short squeeze in the first place. The central clearinghouse essentially bailed out the hedge funds by forcing Robinhood and other brokerages to halt GameStop buying to stop the bleeding by the hedge funds and make sure they had the solvency to cover their short positions.
Well, look, as with everything, I really do take pride in the fact that I have strong opinions, but they're weakly held. I think it's important to have a point of view. And, I come to very quick conclusions. But also sometimes I'm emotional, and those conclusions are more judgments. And then I take a step back, and I'm fortunate enough to have a lot of people around me that question what I said and push back, and then I re-underwrite. And it's not dissimilar to an investment. I try to come to a very quick point of view, but then I get data and I constantly re-underwrite. And, then the heat of the moment passes, deal heat or, emotional judgment. And then what's left is a sober assessment of the truth and facts. And, that's sort of where I am now on this. And frankly, most of the things that I do.
Immediately after the short squeeze, he was very critical of the short-selling hedge funds and Robinhood's buying ban on GameStop. That is what made him so popular within the Wall Street Bets community. But since then, he has moderated his position, and now he says that short-selling hedge funds are legitimate businesses and should be allowed to exist. After initially coming out against hedge funds, he probably got some pushback from his friends on Wall Street. Chamath manages his own money, so he isn't beholden to investors, but he still needs the investment banks and other Wall Street firms to help him source and underwrite his SPAC deals. He moderated his position and softened his criticisms of the financial establishment to maintain a good relationship with Wall Street. So while he tries to come across as anti-establishment and in support of the individual investor, the reality is that he is much more deeply intertwined with the financial elites that he rails against.
One of the things the GameStop episode, let's call it, shone a light on is Robinhood. And not just Robinhood as a company, but zero commission trades and the ability for retail, let's call them retail investors, to participate in a momentum chase. Do you think on balance that apps like Robinhood and the way that they've gamified, and you've heard that term many times, trading, not investing, but trading, is a healthy thing on balance?
I think that it should be allowed to exist. You use the word healthy. Do I think it's healthy? Not particularly, because I think it keeps people in this ghetto of being labor. I started as a day trader, effectively, meaning on the side I would speculate in my teens and in my 20s. An investor is not a speculator, and it's not a day trader. And I think that a lot of retail, a lot of normal people, the only way they will close the inequality gap is because they take it upon themselves to learn how to become an investor. The government's not going to save them. No law is going to save them. No, taxation of the rich is going to save them. They can save themselves. And you have to learn how to invest, which is to put money into the things you care about and then do nothing. And learning that second part is super hard. And so if you have apps that glorify speculation, you're not going to teach the right kind of behavior.
He says that he is against the gamification of trading and advises individual investors to take a long-term view instead of trying to time the market and day trade in and out of positions. This is sound advice, as 80% of day traders lose money, and a much better long-term strategy is to buy and hold high-quality stocks so as to benefit from the long-term appreciation of the market.
Well, maybe I can just give you an insight into how I process any opportunity.
Sure.
Random company comes in to the top of the funnel. Immediately, I'm making a very quick, hopefully it's a decision, but maybe sometimes it's a judgment. And I'm asking myself, does this fit into my worldview or not? Meaning, is it in my circle of confidence? And I have a very simple way of looking at this. Is it going to fix something in inequality that I think is important, or is it going to fix something in climate change that I think is important? Those are the only two things I care about. Inequality and climate change. Under inequality, there's a bunch of stuff. Financial equality is important. Healthcare equality is important. Education equality is important. So it allows me to organize a lot of different opportunities.
Chamath says he only invests in companies that support his overarching goals around reducing income inequality and climate change. While this sounds great, let's have a look at some of his deals and see if they actually fit this description. His most high-profile SPAC, Virgin Galactic, uses jet-powered ships to send high-net-worth passengers into outer space. While it's an incredibly innovative company, the ships emit greenhouse gases, so they actually contribute to climate change. Furthermore, with ticket prices costing $250,000 at least for a 90-minute flight, the company only caters to super wealthy individuals in the top 1%, so it's unclear how it does anything to help with income inequality. Another one of his SPACs is Opendoor, a real estate company that directly buys and sells homes to consumers. While this does make it easier and more convenient to sell your home, it actually contributes to creating more income inequality. Because Opendoor buys homes directly from homeowners, they are taking business away from traditional realtors who earn a commission every time they sell a home on behalf of their clients. While many realtors are successful, most make a modest salary. In many Midwestern states where home values are relatively low, the average income for a realtor is around $40,000. Opendoor is aggressively taking market share, and if it keeps growing, it will put many of these small-time realtors out of business, which will just cause more unemployment and increase income inequality. While Virgin Galactic and Opendoor are very innovative companies and could very well be good investments, you would have to do some pretty serious mental gymnastics to say they are doing anything to improve climate change or income inequality.
You describe finance often as a game rigged in favor of insiders at the expense of outsiders, especially the retail investor, the little guy, if you will. But I would make the following observations, and others have as well, about SPACs. The sponsor gets a 20% promote. Wall Street banks get paid underwriting fees twice. Hedge funds get big share allocations and then cash in the warrants to make a risk-free return. And finally, giant investors like Fidelity, BlackRock, Neuberger Berman, and well-connected billionaires like yourself get to participate in PIPE transactions at $10 a share, right? The same price as the retail investor, but with total information. How is that not a giveaway to insiders at the expense of outsiders?
Yeah, I think this is a really good point you're making. So let me break down a few of these points. Look, the first is that if you can generate superior returns, you should be allowed to compensate and participate yourself in that. When I used to manage institutional money, again, all of this capital is my own, but when I used to manage institutional capital in early stage investing, I charged a 30% carry. No hurdle, no nothing. And people were willing to bet that I could generate returns, and I have, 30+% returns over the last decade, that justified a 30% carry. Similarly here, on the deals that I do, I take a 20% carry. And I think that I can find targets and find opportunities that will make that more than reasonable in the final analysis. And I think that if you look at the returns we've generated for shareholders, it's been nothing short of incredible, inclusive of the carry that I've taken. That being said, I've always thought it was important as well to do two things. Number one, Eric, is to put a lot of my own money on the line so that there was never a question of why I was in this. And I was in this to make sure that I could find great companies that I thought, again, fixed inequality or climate change. But then second, to accelerate those things with our capital and to make sure that I could explain it to people, including normal folks and retail investors.
When a SPAC is raised, the sponsor, in this case Chamath, essentially takes a 20% fee out of the money it raises in the initial SPAC offering. So ordinary investors in a SPAC are already at a 20% disadvantage at the initial buy-in. Chamath says he deserves to take these huge fees because he is such a good investor. Investors are willing to pay him 20% premiums because he is, in his own words, a really good decision maker. At the same time, he says he doesn't need the money because he has so much of it already. While there's nothing wrong with charging a fee for the diligence and process involved in managing a SPAC, Chamath has previously been less than forthcoming about how the fee structure works. Here he is being asked about this very issue on CNBC last year.
Okay, and then we have to talk about the issue we always talk about, which is fees. And I know we went back and forth on this a couple weeks ago with your last SPAC, and Jay Clayton, the head of the SEC, has spoken out and said that he wants to bring much more transparency to fees, given that you want to democratize the IPO process and allow more retail investors and others to get in. Let's just walk through it. I want you to walk through it in a very granular way, how much money you as the sponsor are getting, what percentage of the company you're getting as a result of this.
So in the case of IPOC, I think we invested $16 million to get it off the ground. Now that the deal has come together, we've invested another $160-odd million in a PIPE. The total investment by myself and my partners is about $171 million. The post-money valuation of this business is sort of $5 billion, and so we'll own about 5 or 6% of the business.
You'll own 5 or 6% of the business. That's it.
Yeah. Now, from my perspective, I think that that's a wonderful. Go ahead.
Go ahead.
No, I just think what I'm
just
trying to get across is
there's no warrants. There's no warrants or other preferreds that would get you to a higher percentage of the company.
Again, this is all on a fully loaded basis. So I want to make sure that you're not confusing fees with investment. Fees, I don't make any, right? And just to remember how a SPAC works, a SPAC is not dissimilar to many other investment products. So for example, if you take a private equity fund or a venture fund or a hedge fund, we all operate very similarly. There is a principal. We raise money from investors. We allocate that capital. Typically, funds take a 2% fee every year. We do not. And all organizations typically take 20% of profits if it works. Incrementally, what we do is we reinvest more money from our own so that we are aligned with the company, the employees, and all shareholders. So just to give you an example, Andrew, across all 3 SPACs so far, IPO A, IPO B, and IPO C, we've invested more than $450 million of our own money. Typically, we are 15% of every single dollar invested.
The CNBC host bluntly asked him to go over the fees associated with the SPAC so retail investors know what they're getting into. Chamath does not give a clear answer and tries to obfuscate by talking about how he also invests his own money into the deals. But at the end of the day, investors must be aware that Chamath takes 20% of the money invested already, and that fee degrades the return of retail investors.
If you really want to disrupt a game rigged in favor of insiders at the expense of the outsiders, how else would you like to transform finance?
I do want to have a Berkshire-like instrument that is all things, not to sound egotistical, but all things Chamath, all things social capital. Look, I was the one that backed up the truck in 2012 on Bitcoin, 2014 and 15 in Amazon, 2015 in Tesla. These SPACs are doing well. I can be a little judgmental at times, but I'm a good decision maker.
He compares himself to the legendary investor Warren Buffett, who has a multi-decade history of providing superior returns with his company, Berkshire Hathaway. While Chamath's SPACs have done pretty well in 2020, it's quite the stretch to compare him to Buffett, who is an investing legend. He also says he wants to democratize investing and give retail investors more opportunities with his SPACs. But with Chamath taking a 20% fee at the beginning of every SPAC, the returns that retail investors realize from these SPACs will always be inferior to his own returns.
One of the things Buffett did was effectively hold forever. Right? Put his permanent capital to work and almost never sold. Is that you as well? Is the money that you have in, whether it's Virgin Galactic or Clover Health or Open Door or SoFi, permanent capital that you're never taking out?
Yes, but with an asterisk. Buffett became a billionaire at 58. I, because of Facebook, quite honestly, got extremely lucky in my early 30s. But this last decade has been training. And, these last few years now, I'm really on the field. I got my pads on, and I feel like I can play as good as anybody else. But the reality is all of the things I want to do vastly outweighs the capital that I have. Probably I'm, running $10+ billion, 10, 15 billion. I don't know the exact number, to be completely honest, I should. But I am risk on. And I am moving a lot of balls down the field, myself and my team. And the reality is that those things sometimes consume capital. So at the end of last year, my family office called and said, hey, dummy, you need to put a little bit of money here just to make sure that we have liquidity and we can keep doing all these things. And so I had to sell, a couple million shares of Virgin. I didn't want to. I haven't sold a single share of anything that I've done in the SPAC platform, in the pipes, other than those few million shares of Virgin. So if given my druthers, Eric, and if if I could really just go for it, I wouldn't sell a share of anything I buy because I believe in it. But every now and then I run up into liquidity constraints like everybody else, and I get a call and they say, Chamath, stop, slow down. And I say, no. And then they say, okay, then at least give us a little buffer here so that we can continue to do all the things you want.
He basically just said that he reserves the right to dump the stock of any of these SPACs that he hypes up. Of course, he doesn't admit it explicitly, saying that he is fully invested in his companies, but that he is, quote, a risk-on type of investor who wants to constantly put his capital into something new. So if he ever sells any stock in a company that he takes public, he has a perfect excuse that fits his narrative.
And this Social Capital 3.0 would be a public company.
That's my ambition. I think that I want to be held accountable to folks. I want to, look, I've learned that, look, like, I make better decisions when I am authentic and transparent. And so the best way to do that is just to be living my life out for everybody to see, my professional business life. And so I like the idea of the transparency of the public markets. I love the idea of having investor calls, having an analyst day, teaching people, learning from people, having a yearly thing that Buffett does. I would want to do our own. It won't be as grandiose or as big, but maybe it will in 30 or 40 years. And so, I want to do those things. And look, I'm going to work until I'm 65. And so between now and 65, that's the goal. And, to be honest with you, I don't have a very high regard for money. And I don't know Mr. Buffett to really tell you what he thinks about it, but I grew up with nothing. I'm going to die with nothing. And this is purely an instrument that I can use to put the foot on the gas. So I'll give you an example. Mm-hmm. Today, for all the ballyhoo talk about climate change, China controls 80% of lithium-ion battery production. And so to the extent that we ever get into a geopolitical posture where China decides to slow down the progress of the United States, one of the ways in which it can do it is just to basically slow the trickle of the critical inputs and precursors that we need to make batteries. No batteries, guess what, Eric? No climate change. And so, that's an area that I'm going to invest in, and that's an area I'm going to go for it. Is it risky? Yeah. Will it cost several $billion? Probably more. Could it fail? I think if we think through it from first principles, I think it has a very high degree chance of being successful. But, I'm going to make a huge bet.
Here we get to see some of his true purposes and ambitions. He is planning on launching a public company as the next iteration of Social Capital. Right now, he is building the perfect platform to do this. He has pretty much gained the support of the retail investors, built goodwill with the public by portraying himself as standing for issues like climate change and wealth inequality, and developed a reputation as a super successful businessman with an 11-figure net worth. If anyone can launch a successful Berkshire Hathaway type company, especially one that focuses on an industry intimately related on electric vehicles, it would be him.
That's really good for everybody.
In addition to Bitcoin, which coins, if you will, cryptocurrencies, digital assets, are you a holder of? Are you a believer in?
Well, I will be publishing this soon. I am building a fairly sizable portfolio of what are called NFTs, non-fungible tokens, some digital art, some virtual trading cards. And these may sound crazy to some, but I do think that that's the next frontier of digital currency and digital assets.
I don't know. What do you guys think? Is this a legitimate way of investing? Or do you think it's a way for Chamath to front-run retail investors on underdeveloped markets like the CryptoKitty market, then announce his position and dump these crypto assets once his followers copy his trade?
Chamath, you've been an outspoken critic of Gavin Newsom and even stoked speculation that you might run for governor of California. What are your political ambitions? Do you have any?
I would like to promote centrism, and I would like to coalesce people around centrist, normal, moderate goals of progress, and then to have candidates who can carry the water on that platform. That's my real political ambition. I don't have any particular ambition to run, particularly because the implications of doing that job day to day, for me, I think are a little under leveraged, in the sense that, the conflict of interest and the divestiture rules would force me to cripple a bunch of things that are really important to me. I mean, going back to batteries, I couldn't do anything. If I thought that it was really important for me to secure lithium supply for United States battery manufacturers, I mean, today I can just write that check, right? I can mobilize the capital and I can go and get that and secure the United States supply of lithium. I couldn't do that if I was governor. And so I wouldn't be able to act in ways that are important for us.
Chamath is referring to his tweet in January 2021 about running for governor of California under the impossibly optimistic platform of eliminating income taxes, massively increasing teacher pay across the board, and solving climate change. Now, in this interview, it kind of sounds like that was nothing more than a PR stunt on his part to build his image in the public eye. But it seems like now he's saying that his ambitions for humanity, like securing the lithium supply for the American electric vehicle industry, would actually be hindered by being the governor of one of the most powerful states in the US. Instead, he thinks the world would be better off from his private sector contributions to humanity.
Have you given thought to how much money you want to put behind these candidates whom you'd like to see in office espousing the ideals you share?
On the assumption that, Citizens United doesn't get overturned, my plan will build. It's not that today. Today it's in the millions a year, but my plan will build to hundreds of millions a year. I mean, look, think of what has happened in American politics because of the Kochs or the Mercers. What is the moderate version of that? Where are the group of people that over 20 or 30 years can systematically build an infrastructure that promotes just centrist decency? It doesn't exist right now. And so, I would like to build that, and I'm happy to, pay my share of that.
Here he says something a little subtle. He plans to ramp up his political contributions to the hundreds of millions at some time in the future. He talks about his vision for a better tomorrow, and now he's happy to pay for his share of that. But that's really no different than any other billionaire saying that their political donations are for the common good. Even when the intentions are good, sometimes it ends up looking more like the billionaire funding their own political beliefs more than anything. So there you have it, guys. Chamath Palihapityia, who says he is for the retail investor and who has come out publicly in support of Wall Street bets, but has been accused of using this as a way for him to make more money on his SPACs. After this hour-long interview on Bloomberg, we've seen a little bit more into his ambitions and outlook for his businesses. So what do you guys think? Is he a true Wall Street bets ally or a fake populist? Is he telling the truth about climate change and income inequality being his driving forces, or does he pump his SPACs for his own profit at the expense of retail investors? Let us know in the comments section below. Also, make sure to like and subscribe and follow us on TikTok and Instagram. In the meantime, thank you guys so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.